This is a continuation of the Danielcode trading manual, and we were looking at chart 9b, where we have the S&P futures contract, and we have now put on two sequences of the Danielcode numbers, and you'll see they are in blue. The reason they are in blue is to show us that they are extensions of the range. The other colours you'll see later are red and black, which are retracements of the range. So for clarity, you can see that the numbers we're concerned with are outside the range of the more recent price action. So we're taking the matrix around the various highs in that structure, and I'm calculating the Danielcode numbers and putting them on in blue, which means they are extensions. They are outside the previous range of the chart. If you look at those arrows now, you'll see that they show us all sorts of Daniel recognition signals as to how markets have responded when they've come to these numbers. If you look at the arrow number 1, you'll see that that market bottomed at near 1134 and had a huge intraday reversal. If you'd known that Danielcode number was there and got the reversal, you'll see the gap up the next day. There was about 70-75 points in that trade for you. If you go to the next, number 2, you'll see that the market gapped down past the Danielcode numbers, and there were two of them there. That's how markets often deal with significant resistance and support. It gapped down past it and it made its high of the day at the Danielcode number. We move on to arrow number 3. You'll see that daily bar came down, opened at the Danielcode number 976, traded up just through the Danielcode number above it, came back and closed on the Danielcode number. That's another form of recognition. We see markets closing on the Danielcode numbers. Bar number 4, down it went. Its low for the day and its close was right at that point where there are two Danielcode numbers at 909.80 and 911. And we call that, where we have two numbers from different sequences meeting at the same place, we call that 2 degrees of Danielcode numbers. Are they stronger? Well, intuitively you would think that where you have a conjunction of numbers they are stronger, but backtesting doesn't support that. The next number 5 you'll see was the bottom of the S&P market in October, and there we saw the market gap down. You had a huge gap down from the previous day's close. The low went to the next Danielcode number, 838.05, and you'll find the low on that day is just a few ticks from that number. So we got the intraday reversal right at the Danielcode number. Next day it roared up, and the third day it gapped up, and there was 110 or 107 odd ticks in that trade. So you can see how markets react. But line 6 is a replay of line 5. The market opened above the Danielcode number at 911, charged down on very panicky selling and commentary. Where did it stop? 864, just at the Danielcode number. And then we got the intraday reversal from that. Now markets do this all the time. This notion that there's panic selling, that there's margin calls, that there's hedge fund liquidation, all of that may well be true, but it doesn't change the fact that all markets turn at the Danielcode numbers. So if you look at the lows on the numbers that I put on this chart at 5 and 6, both of those days were called as huge panic days, end of the world, drama without end. Where do they turn? Exactly at the Danielcode numbers. In fact, the bigger the volatility, the better the turns at the Danielcode numbers. So if you can just look at this stuff and start to understand that despite what you may be hearing, reading, or any other external commentary, all markets turn at the Danielcode numbers, and they have done so forever. This is not a new phenomenon. If you took the details of the rice market, for which we have data going back 1200 years, even in the rice market, all markets turn at Danielcode levels. We'll now move on to chart number 10, and on this I've put some swing points. So I want to talk to you about the concept of swings, and this is just a 6-bar swing. That means it creates a bar when there are 6 bars either side of a high or a low. So how do we know that a bar is a high? Well, it will have a lower bar on either side of it. If it has more than one lower bar on either side of it, we can pick that up by using this swing tool. In this particular case, I've asked it to create the swings at strength 6. That means that there must be 6 lower bars before it and a number of bars after it to create the swing. But I just want to give you a visual effect of what the swings are, because I'll often say in the chart commentary of the Danielcode, this market is correcting the minor swing, or this market is correcting the major swing. If we look at the most recent low, and this happens to be the COMEX gold chart in chart number 10, you'll see that you can trace the blue line straight up from the low, 1, 2, 3, 4, 5, 6, 7, 8 bars into a high, then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, about 11 bars into a low, and then back up to the previous high, which is a higher high. If we were talking about correcting from the point at which the blue line ends, we would then say we have 2 swings there. We have a minor swing, which takes us up to the first point in the blue line, and a major swing, which takes us up to the ultimate high. So that's what we mean when we're talking about swings. The next chart, chart 11, introduces you to the other coloured lines in the Danielcode packages, and these are red lines and one black line. And these are retracements, and the difference is that these lines are measured as a percentage of the previous swing. So we're now looking for price action within the swing. So if we go to the top of the chart, you'll see that I've noted for you there the swing retracements to use. They're in the members documents at the Danielcode website, but the most common retracements on charts are 37.5%, 50%, and 62.5%. Now those numbers you'll see are quite close to the more commonly used Fibonacci numbers, but the rest of the sequence is quite different. I in fact use a slightly different sequence because over time the sequence, and by time I mean thousands of years, the sequence has changed slightly from its original calculation, which was done in 640 BC.